when I look at investments, it's not about, of course, I look at the tail conditions on both sides, but to me is what is the most likely scenario? Is it impossible to have a soft landing? No. I mean, is it impossible for pigs to fly? I've seen pictures of pigs in an airplane. So yeah, that's possible too.
We're speaking now with AXEL Merk. He is the president and CIO of Merk Investments, and we'll be talking about the Fed, markets, and his coming recession outlook. Welcome back to the show, AXEL. Always good to see you.
Great to see you, David.
Let's start with some recent news. Fed Governor Michelle Bowman said over the weekend that the Fed likely will need to raise rates even more down the line. She said, I also expect that additional rate increases will likely be needed to get inflation on a path down to the FOMC's 2% target. And she hinted that rates will stay elevated for longer as well. Now, markets reacted, well, maybe not to this solely, but Treasury yields are slightly up on the day on Monday. The dollar is slightly up. Gold is down, and the equities are up. So assuming that the markets buy this expectation that rates will either, one, go up even more, and B, stay elevated for longer, how do you think the markets will respond to these moves down the line, further down in the year?
Sure, except the markets, of course, didn't buy that interpretation. What's priced into the markets is that there is not going to be any more rate hikes. And by the way, John Williams came out and he thought it's all done. And early next year, maybe we can even have a cut. He, I think, is the first one to talk about a rate cut a tad more openly. But to the substance of what you're referring to, the problem, and I think we've discussed this before, the problem with high inflation is that the way down is not linear. So even if we assume we have several months where inflation numbers coming out are not all that bad, that doesn't mean we won't have a number that's higher than expected at some point down the road. And also keep in mind then when Paul Volcker beat inflation in the early 80s, we didn't go back down to 2%. We went down to like 3-4% for several years. And so, and all this is in the context of what I say a lack of strategy at the Fed. Higher for longer tells you nothing about the path forward now that we've presumably had the last rate hike. And so that only means, yeah, at some point they presumably will cut. But that tells you little of whether inflation has been beaten or not. And so the market shall be excused for thinking inflation rather than rate hikes. Inflation might be higher for longer.
Now, some people have said that the Fed has gone too far and will continue to go too far if they keep raising rates. This too far, we'll talk about your recession outlook and your economic outlook in just a bit, but this too far, I'm wondering if that also extends to inflation. Could we get a scenario in which deflation could actually happen because rates are too high?
Well, first of all, of course, the Fed is going too far. What else do you expect when you don't have a framework? They have a sledgehammer. Inflation is high, they use the sledgehammer. Imagine a world where you might have a rules-based Fed based on inflation and unemployment. Then it would be forward-looking, then rates could credibly come down. But Powell can't credibly lower rates. And so that's why almost by definition, they will go too far. And by the way, they almost always go too far because of that challenge, right? Because what else are they going to do? Inflation is high, they don't have a strategy, they don't have a crystal ball. And so they wait until inflation comes down, and historically it means they need to have an economy that tanks. And that's presumably what they'll be waiting for.
So do you think that the Fed needs to hike rates even more? Keep in mind that they already have quantitative tightening on the side. The money supply M2 growth rate has been negative. The question is whether or not they will need to continue raising rates to obtain their objective of lower inflation.
What they need is a credible strategy. What they need is, the economists refer to it as a reaction function. What they need is publicly and internally, and most notably, discuss what went wrong, why they were late. When you have a debating committee, you're almost by definition late in taking action. Now, they're not going to be late when there's a major crisis hitting. They can provide liquidity right away. But for the important things, like long-term strategy, there are some structural deficiencies. Now, in the absence of that, yes, I mean, it would be helpful if they had been a little bit tighter earlier. But going forward, we have a quote unquote slightly restrictive policy. Now, that said, we gradually have various economic indicators turning negative. And so we'll get that slowdown. That said, we still have wage pressures in some sectors of the economy that are higher than they should be. And the way you fight it when you only have a sledgehammer is by hiking rates. And so from that point of view, they should continue to hike.
Okay, so your expectation is that more rate hikes will come.
No, I don't.
No?
I don't
No, you
expect them
don't?
to do more rate hikes. I expect them to be sitting here and hoping for the best. Hope isn't a strategy, but that seems to be where we're at. And part of it is because we do have inflation numbers coming down. We do now have various indicators that credit conditions are tightening. Keep in mind that the last bits of the post-pandemic aids are gradually running out, including student loan payments have to resume. And so, and then the big thing out there, and we haven't touched on it yet, is commercial real estate. Now, in a consumption-based economy, why would you bother about commercial real estate? The reason why you want to worry about commercial real estate is not that I think the world is coming to an end, but small banks with huge exposure to commercial real estate, they have decent loan to value ratios, so they're not going to go bust, especially not with aid from the Fed, but they've also mismanaged interest rate risk, which means small banks will be reluctant to lend. That's abstractly speaking, a tightening of credit conditions. It's a bit like the savings and loan crisis in the 1980s. These banks will not be eager to lend. The question is whether somebody else will step in. Big banks are not equipped to serve the same customers as the small banks are. And so they'll find other ways. They'll probably go to private markets and whatnot. But it is a big headwind that will be with us for an extended period, in addition to the COVID aid running out, in addition to the high interest rates. So monetary policy acts with a lag, and that's the sort of lag that will become overwhelming to economic growth over time. And to address your question on whether it's going to be deflation, because I sidestepped that. Yeah, well, of course, in some, used car prices have deflation, right? It's always an up and down. When you have a contraction, yes, some prices will come down. I don't think the overall CPI numbers will be coming down, though.
Yeah, let's talk. Yeah, we haven't talked about overall CPI yet. So your view is that the Fed will likely not raise rates again. They're going to be data dependent. What's going to happen to CPI then if we just keep rates the same?
It's going to be volatile, right? It's going to be gradually coming down a bit, but once in a while we have a spike higher. And because of that lack of strategy at the Fed, it's going to induce volatility. And keep in mind, we're talking about an environment where the markets are a tad pricey, at least in my view. And so when you have numbers that don't fit the scheme, think about the latest jobs report we had, right? Everybody is kind of, after the ADP report was a bit hot, oh my God, what's going to happen? Yes, but being glued to a single number is not a strategy, right? And in one way, we are lucky that we're in August, where the markets are super dull. And so we can actually afford to take a step back so that we're ready that after Labor Day, when volatility presumably or possibly comes back, we can be prepared for what's coming up.
What do you think is going to make the Fed pivot?
Well, there are two things. The one is a crisis, right? The unknown. That's always, and that's, by the way, why there's always further out the market prices in some rate cuts, because the odds of that happening just increase with time. Markets have absorbed some pretty interesting things, including what the Silicon Valley Bank blow up and the fear that people had about the banks. So that's one segment. The other one is when a recession is staring in our face, in conjunction with inflation numbers that are a tad more benign. Won't be at 2%. And of course, the challenge they'll have is, how do we justify, if inflation is hovering around 3 to 4%, that they start lowering rates? They will need to communicate a new framework before they can do it. What we do know is that the higher for longer framework will get them to cut rates later than they otherwise would. And just as I discussed, like there's a lag in monetary policy, it's going to take a while for it to filter through. And of course, there's going to be ripple effects. Odds are we're going to be smack in an election cycle here when the worst of the recession hits.
Yeah, and let's talk about your recession outlook then. Before I talk about other firms' research, I want to get your take first. What indicators are you looking at that can point to a recession that may or may not be staring in our face right now?
Well, we cook with salt like everybody else is of course, right? And so we look at financial conditions. There are various indices that we look at. The Chicago Fed has one that's a bit better. Many financial condition indices mostly look at the VIX index in the market, and that's pretty useless in my view because that just tells you about market sentiment. Lending standards, the senior loan officer survey, I think is an interesting one. Real interest rates is a cross check as a data point. But then you look at the ISM numbers, the Institute for Supply Management. And of course, we've had this disconnect between the services and the manufacturing side. So some people are saying, oh, this is a rolling recession. And there's, of course, some truth to it, but it's in the context of the US economy relies on the consumer, the stimulus is running out, and then credit conditions will also tighten because banks will simply be afraid to lend. When they have commercial real estate on their books, and just for context, right? If people can relate to when in 2008, right, it takes forever for homes to go through the repossession process and so forth. Well, commercial real estate, banks are not in the business of managing real estate, but it takes a while. And so while these assets are distressed, banks will not be happy to lend, and that will, in the aggregate, have an impact. So it's those longer term things that make me more negative. Those two say, hey, we're going to have a soft landing, either underestimate or discount that these sort of effects will not going to have an impact. I just don't see how it cannot have an impact.
Let's just clarify. Are you saying no recession this year or not at all for the next couple of years?
No, there were those who say, I mentioned, right? I do think there is going to be a recession, but there are numerous people and an increasing number in recent weeks in the soft landing scenario. Because numbers have been holding up. And to me, the recession always, not always, but unless there's a crisis, recessions tend to come later than people anticipate. And of course, right, one thing, the balance sheets of consumers were healthy in the pandemic, in part because of the help. Consumers may stick around a tad longer than some people anticipate, but it doesn't change the broader forces of tighter conditions out there, more restrictive credit, high interest rates, and of course, it's possible that we have a soft landing. When I look at investments, it's not about, of course, I look at the tail conditions on both sides, but to me is what is the most likely scenario? Is it impossible to have a soft landing? No. I mean, is it impossible for pigs to fly? I've seen pictures of pigs in an airplane. So yeah, that's possible too.
Okay, well that's I haven't, so I like to go on the same airplane as you. But AXEL,
you should be watching some of these aviation groups. Yeah.
So do you have a timeline for this recession? I think when listening to you speak, a lot of people agree with you. A recession is coming. I've heard various timelines. For the record, on my show, no one has ever told me there will be no recession. People have said it may not happen this year. People have said it may happen only until the end of next year, but eventually we will have a slowdown. What's your view?
So first of all, let's make sure we talk about the same thing. In the US, unlike other countries, it's actually a bunch of bureaucrats decide on whether we have a recession. It's not simply 2 quarters of negative GDP growth. And so the NBER has a bunch of parameters. And so one can look at these sub-indices and see whether they start moving down, and then they'll announce it with hindsight. The reason we care to maybe take a step back is because historically speaking, risk assets have performed poorly during recessions. And that's kind of the key reason why people want to worry about it. We focus on precious metals. They tend to do better during a sharper downturn. A shallow downturn, people look ahead and risk assets can do well. So that's for the context here. Right now, it's just mathematically difficult that a recession will be announced, even with hindsight, to have started before quite late this year. So if you were to nail me down, it would presumably happen early next year. But I don't want to get too technical, right? To me, the markets are forward-looking. I mentioned after Labor Day, you need to pay attention. It is suddenly, at some point, people start focusing about the next year, right? It doesn't matter whether the recession starts on this particular date, but suddenly, and it's in the context of valuations, right? People have been thinking about, oh my God, this Goldilocks economy, and then anything or nothing will change the mindset of the market, and you want to be prepared before that. Now, if you're a long-term investor and want to hold equities forever, by all means, right? They historically have done well.
Why do you think, you were right in saying that a lot of people have switched to a soft landing view? I'm talking about Wall Street firms. Why do you think Wall Street is a bit more bullish in their views? Morgan Stanley recently switched their economic forecast to a bit more positive. They're saying soft landing, inflation falling without a recession. Bank of America just last week upgraded their view to no recession, soft landing. Citigroup and Goldman Sachs both raised their S&P 500 year-end target. What are they looking at that perhaps we're not discussing?
Well, because some of the economic data points have been decent, right? Especially the jobs report has been decent. So there are, and that goes into this rolling recession scenario, the argument that the US economy is highly diversified and can stomach it. And it's possible, right? I don't rule it out. But keep in mind also that we talked about, oh, is the Fed going to hike rates? Well, let's assume for a moment the Federal Reserve is going to be higher for longer, and inflation numbers are gradually going to come down. That means short-term real interest rates are going higher. That is a form of tightening. So again, I'm coming back to how can we not have a recession? Now, Wall Street might be more focused on the next 3 months, right? And of course, at some point in the distant future, we'll have a recession. Also keep in mind that this is probably the most forecast recession ever. And so anybody who has taken steps to prepare for it. But it gets me back to and including consumers, by the way, that locked in low interest rates. But it gets me back to saying that commercial real estate will have smaller banks not be lending. That's a tightening of conditions. And if you look at surveys, a senior loan officer survey, for example, is one of these reports, financial conditions are tightening. And so it's I don't know. I respectfully disagree with the soft scenario.
So if you believe that real interest rates, especially on the short term, will go up, would that not be bearish for something like gold?
Yes. So if you look at real interest rates, it is very remarkable how well gold has held on. Keep in mind, markets are forward-looking. And say, when you look at anything, including gold, do you hold this brick or do you hold treasuries? Well, you're maybe inclined to hold the brick if you then don't get compensated for holding treasuries. And I like to look at longer-term inflation expectations. Now, I realize many of your viewers will say, well, what the hell are they good for? Nobody knows what inflation will be in 5 to 10 years from now. I agree, but market perceptions matter with regards to asset pricing. They're not going to tell you what inflation is going to be in 5 to 10 years, but they will tell you what the market perceives them to be. And so if you think that we've reached peak hawkishness in that context, then gold might be doing well. Now, if you have a Federal Reserve that's completely stubborn and oblivious to a slowdown and will never do anything, well, it depends on this reaction function, right? I mentioned the Fed has no strategy. So everybody has to think what they might be thinking. If they communicated that they had a plan, then the market could price in more readily where the price of gold or any other asset might go. For now, everybody's reading tea leaves. And my interpretation is that the reason why the price of gold has held up reasonably well is because they don't buy it. They don't think that in a recession, that the Fed won't be doing what they always are doing, and that is to lower rates. And indeed, if you look at what's priced into the market, by early 2025, we're going to go down 3% right now, just under 3 right now.
It's interesting how gold is perceived as an inflation hedge, but during a recession, historically, gold has performed well during recessions, but historically also recessions have been coupled with lower inflation. So can you explain that, how gold doesn't go down during a period of low inflation?
It's a misnomer to correlate gold to inflation. Anybody running a correlation will see that that's pretty useless. It is about the biggest correlation we see if you look at something like 10-year real yields. That's the TIPS yield, for example. Now, as I'm speaking here, we're about 1.7% at those real yields. If you think we're going to go much higher than that, and historically that's quite high over the last 20 years, by all means, the price of gold could be going lower. But if you think that at some point the Fed might have to ease off of that and the market will start reflecting that, then gold might be a good place to be. And if you also, the other thing is, of course, while correlations to equities morph in and out, if you think equities are overvalued, it's one of the few ways you might be able to diversify. So there are various ways that one could make an argument for the price of gold. But if you think that we will live in a new environment where the Fed is going to be super tough, then maybe gold is not the place to be. Just one thing we haven't mentioned is the fiscal state of the country. Now, there is no correlation of the deficit directly to any other market metric. But we are in a good economy, a hot economy, and have substantial deficits. Now, let this recession come true, and let Goldman and company be right that the recession is only coming in 2 or 3 years, whatever. How is the government going to react to that? I mean, usually it reacts with a fiscal stimulus, right? And so if during a good period our deficits are substantial, then what's going to happen during the bad period? And even if the Fed is going to be tougher than it's historically been, there is going to be valve somewhere, which may well be the currency, right? And if the dollar weakens, that historically has been a tailwind for the price of gold. And so, if anything, gold continues to serve its role as a diversifier. I continue to like it, but clearly, of course. And by the way, one investor who's not in gold these days is the speculator. The speculator moved to meme stocks, to crypto assets and whatnot. For them, the price of gold is simply too boring. And to me, that's a good thing, because indeed, if we do have a more significant recession scenario, some of the quote unquote funny money will kind of come back, and it's only when the speculators truly embrace gold again that I think we might be reaching a peak.
Just on your fiscal point, is your view that because down the line, because of some sort of economic slowdown, there will need to be more fiscal stimulus, that inflation will return because of the fiscal stimulus?
Well, it means that the currency might be less stable, right? I mean, of course, we had too much of a fiscal stimulus, and that induced inflation. If we have a more severe recession, it really depends on the amount of stimulus. And if we have gridlock in Congress, we might not get, quote unquote, too much. But similarly, just as I criticize that we don't have a strategy at the Fed, we don't have a strategy on the fiscal side to create sustainable deficits. You can run just about any economy, but it needs to be sustainable one way or the other. And this is not a secret, right? Most economists agree that the entitlements are unsustainable. The question is how they'll be fixed. And if the Eurozone debt crisis is any indication, kicking the can down the road is really the one tool that's in the toolbox of our policymakers. And so they'll make the tough decisions, but only if and when the market forces them to do those. And I think we are still a little bit off from that. So for the time being, I think spending is going to be the name of the game. And in that context, that might lead to a weakening currency.
Okay. Can you sum everything up for us? So let's assume that you're right and that we will get a slowdown sooner rather than later. I'm assuming the markets are not pricing that scenario in. What should be the fair value of, let's say, the S&P 500 and also gold?
Yeah, I'm very reluctant to play the price game. What I try to tell people is that if you get nervous about your investments and can't sleep at night, that means you're overexposed. Keep in mind also, for most investors, beating the S&P is not the holy grail. They want to retire. They want to support their style of living and whatever ideas they have. And so in that context, diversification is key. We talked about equities, touched on bonds, we touched on precious metals, right? In an environment where government doesn't have enough money, they'll increase taxes, presumably, in an effort to get more. And so you can
or cut spending, or just cut spending. You don't think they'll do that?
That's not the thing that politicians like to do.
Okay.
I mean, that's you have a very high regard to our dear politicians. I mean, who knows, right? You tell me what Congress is going to look like in a year and a half, and I'll tell you. But I have my doubts based on my current outlook.
All right, fair enough. Now let's talk about your strategies. Merk Investments. Tell us a little bit about the fund that you manage and what the overall strategy is here right now.
Yeah, so we manage a little over $1 billion. We have currently, I believe, 3 exchange-traded products in the market: a physical gold product, a gold mining strategy, and a stagflation strategy. The physical gold strategy is literally holding physical gold, competing with the big ones, and investors can take delivery of the gold, including a conversion to coins. So that's a neat feature on that. On the mining strategy, it's a closed-end strategy where we help fund junior exploration companies and allows retail investors to gain access to that. It's a very unique vehicle. It's extremely volatile, so it's not for the faint of heart. So please look at that carefully. And then we have our youngest strategy, a stagflation strategy, that is a strategy that if you believe we've reached peak real interest rates is something you may want to consider diversifying to. We put this together towards the tail end of the pandemic, mostly because, as I mentioned earlier, when inflation comes down, it's not a linear process. And also, we didn't touch on that, when you're faced with a supply shock, the typical reaction by policymakers is to do the wrong thing, like giving you a stimulus check when there are not enough supplies. And it's those dynamics that cause problems. And if you look at the 1970s, equities on a real basis didn't perform well. And so how do you diversify beyond that? There are various ways you can try to address that, and the stagflation ETF that we launched is one attempt at providing investors a tool to do so.
I'm curious, can you just give us a few things of what's inside your stagflation fund?
Yeah, so the bulk of the investments invest in tips, and then we diversify to oil, gold, and real estate. And the reason we chose those is because those performed well in the 70s. A simplified way of, and then there's a rules-based adjustment that's a trend-following methodology. And the reason we use trend following is because, again, that worked well in the 70s, trying to add some value. And the end product of that is one that, in our view at least, performs decent in a normal environment and particularly well in a stagflationary environment. I don't think the fears of stagflation are gone. Many people are saying it's yesterday's problem. But we do believe, ultimately, if you think that inflation expectations might be moving higher, then it is something investors might want to have a closer look at.
Okay, interesting. And where can we access the fact sheets and learn more about these ETFs?
Come to merkinvestments.com, and from there are various links for which you can then look at these products. And also follow me on Twitter. I can't talk about products there, but you get the unfiltered views and instantaneous interpretation.
Wait a minute. Are you saying you're filtered on my show? What's going on? I'm kidding. All right. Follow AXEL on Twitter. I'll put the links down below to also Merk Investments. Thank you very much. And we'll speak again next time to see how the Fed reacts during, we haven't talked about Jackson Hole. That's coming up. So we'll see what they do in a couple weeks at Jackson Hole. Thank you very much today, AXEL.
Thank you.
And thank you for watching. Don't forget to subscribe.